Welcome to Mindcast. I'm your host, Will, and today we're diving into something absolutely revolutionary that's happening at the intersection of artificial intelligence and financial markets. Picture this. We're living through the most explosive technological revolution in human history. AI is reshaping everything from how we work to how we think. But there's a massive infrastructure crisis brewing beneath the surface. The computational power that drives these AI systems, what we call compute, has become the new oil, the new electricity, the new critical resource that our entire digital economy depends on. But here's the kicker. Unlike oil or electricity, we don't have sophisticated financial markets to manage the massive risks and volatility in compute pricing. That's about to change in a big way. Today, I'm breaking down a groundbreaking financial framework that could transform how we trade, hedge, and invest in computational power itself. We're talking about something called the Quality Adjusted Compute Unit, or QACU. And trust me, this is going to change everything. By the end of this episode, you'll understand why some of the smartest financial minds are saying that compute futures could become one of the largest commodity markets in the world. We're talking about a market that could dwarf traditional commodities, and it's happening right now, right under our noses.
Let me start by painting a picture of just how insane the current situation is. Global electricity demand for AI training and services is projected to quadruple within a decade. We're talking about data centers that consume power on a gigawatt scale. That's enough electricity to power entire cities. When a major tech company announces a new GPU procurement deal, we literally see their market cap swing by hundreds of billions of dollars overnight. One company recently added $250 billion in market value just from announcing their upcoming hardware order book. Think about that for a second. We have an entire sector of the economy where the underlying resource, computational power, is so volatile and unpredictable that single announcements can create or destroy more wealth than the GDP of most countries. This is not sustainable, and it's creating massive systemic risks. The core problem is threefold. First, AI infrastructure faces incredible price volatility. Unlike traditional commodities, compute can't be stored in warehouses. You can't stockpile computational power for a rainy day. It's produced and consumed instantaneously, just like electricity, which creates these wild price swings during demand surges. Second, we're dealing with massive capital requirements. Building AI infrastructure requires pre-ordering and deploying multi-billion-dollar GPU clusters. Companies are making enormous capital expenditure bets years in advance, with no way to hedge against the risk that their expensive hardware will become obsolete or that compute prices will crash. Third, there's this unique challenge of technological obsolescence. This isn't like buying oil rigs or power plants that last for decades. In the compute world, Moore's Law is still driving exponential improvements in hardware efficiency. Today's cutting-edge GPU might be tomorrow's paperweight, and there's no financial instrument to protect against that risk.
All of this adds up to a fundamental market failure. We have hyperscalers, AI labs, and cloud providers making multi-billion-dollar bets with essentially no sophisticated risk management tools. It's like trying to run a global energy market without futures contracts or derivatives. It's financial insanity, and it's limiting how fast we can scale AI infrastructure because investors can't properly price and manage the risks involved. So what's the solution? Enter the Quality Adjusted Compute Unit, or QACU. This is where things get really interesting because we're essentially creating a new form of commodity that's never existed before. The fundamental challenge in creating a compute futures market is that computational hardware is incredibly heterogeneous. You can't just say 1 GPU hour equals 1 GPU hour because a GPU hour on a cutting-edge 100 chip is completely different from a GPU hour on a 5-year-old graphics card. It's like trying to create an oil futures market where crude oil from different wells has wildly different energy content and chemical properties. The QACU solves this by creating a standardized unit of sustained computational utility.
Think of it as the computational equivalent of a barrel of oil or a megawatt hour of electricity. The QACU is calibrated primarily by T-flops output. That's trillions of floating point operations per second, but it's crucially adjusted for architectural efficiency and specialized features that are essential for large-scale AI model training and inference. This isn't just about raw computational power. The QACU accounts for things like tensor core efficiency, memory capacity and bandwidth, and other architectural features that make certain chips dramatically better for AI workloads. It's a quality-weighted measure that creates true fungibility across different hardware generations and architectures. But here's where the mathematical rigor becomes crucial. Creating this index isn't as simple as just multiplying performance metrics together. The researchers behind this framework learned from the mistakes of other composite indices, like the quality-adjusted life year used in healthcare economics. Simple arithmetic aggregation of components measured on different scales can create indices that aren't mathematically coherent. They can give different results depending on how you scale the inputs. Instead, the QACU uses advanced statistical weighting methods, potentially including principal component analysis or carefully designed geometric means to ensure the index accurately reflects combined computational utility and remains mathematically robust. This is the kind of technical sophistication that separates a real financial instrument from a back-of-the-envelope approximation. Now, let's talk about the financial modeling challenges, because this is where things get really fascinating from an academic perspective. Compute shares a critical property with electricity. It's non-storable. You can't warehouse computational power for later use. This creates fundamental problems for traditional commodity pricing models that try to derive futures prices from expected spot prices. The solution comes from electricity markets, which faced the exact same challenge decades ago. The framework uses something called the Heath-Jarrow-Morton methodology, or HJM, which models the entire term structure of futures prices directly, rather than trying to derive it from highly volatile spot prices. This is a much more stable approach when dealing with non-storable commodities. But here's where compute becomes truly unique. We have to account for Moore's law. This is the predictable exponential rate of technological progress that creates a structural, continuous deflationary pressure on computational costs. Efficiency and performance density roughly double every 2 years, which means compute gets cheaper and better at a predictable rate. This requires augmenting the standard commodity model with what's called an exogenous structural factor. The long-term price factor must include a deterministic negative drift term, let's call it μtech, that accounts for technological progress. If technology dictates an approximate 35% annual reduction in the real cost of a quarter-ampere computing unit, then this drift term must be set accordingly. This creates something that's never existed in commodity markets before: structural perennial backwardation. In normal commodity markets, backwardation happens temporarily when current scarcity drives spot prices above futures prices. But for compute, this condition is permanent. The market expects computational resources to be inherently and substantially cheaper in the future due to technological progress. Think about the implications of this. Unlike oil, where futures curves fluctuate between contango and backwardation based on market conditions, compute futures will almost always trade at a discount to current spot prices. This isn't market pessimism. It's the rational expectation that technological progress will make today's compute seem expensive tomorrow. This also creates unique risk management challenges. The researchers propose a two-factor stochastic model to handle the distinct drivers of compute pricing. Factor 1 represents long-term technology cost, driven primarily by Moore's law, with relatively low volatility. Factor 2 captures short-term deviations from the technology trend, those wild demand surges and supply shocks that create extreme volatility in the spot market. The parallels to existing commodity markets are striking, but the differences are what make this so exciting. Like electricity markets, compute faces extreme spot volatility driven by instantaneous supply-demand imbalances. You can't smooth out a sudden AI model launch that creates massive compute demand by pulling inventory from storage. There is no storage. But unlike electricity, compute has this technological deflation factor that's predictable and structural. Oil prices might fluctuate based on geopolitics and supply disruptions, but there's no inherent technological force making oil continuously cheaper and better over time. The energy connection goes even deeper. Data centers could consume 1,600 terawatt-hours by 2035, representing about 4.4% of global electricity consumption. The financial risk profiles of compute providers and energy suppliers are becoming increasingly correlated. This means QACU futures could serve as an implicit hedge against future carbon taxes and climate policy risks for major AI developers. Think about it. If carbon pricing increases electricity costs, that directly increases the marginal cost of providing compute. By incorporating expected future energy prices into the term structure of compute futures, these contracts become a hedge against regulatory changes that could dramatically increase operational costs for AI infrastructure. This is where the implementation strategy becomes crucial, because we're not just talking about academic theory. There are multiple paths to actually building these markets, and they're all happening simultaneously. The first path is over-the-counter development. Given the complexity of tailoring initial hedging solutions to large enterprises, compute futures will likely start with bespoke, private contracts negotiated directly between hyperscalers, AI labs, and institutional end users.
This decentralized OTC environment serves as a testing ground for standardizing contract terms and provides the initial transaction data necessary to calibrate pricing models. The second path is centralized exchanges, following the traditional model of the Chicago Mercantile Exchange or Intercontinental Exchange. This requires comprehensive clearinghouse support, strict collateral requirements, and sophisticated counterparty risk management. It also means years of regulatory engagement to get agencies like the CFTC to officially recognize QACU as a financial commodity. But the payoff is institutional credibility and the deepest possible liquidity. The third path is the most interesting from a technology perspective: decentralized finance. Decentralized cloud providers like Akash Network are already operational, offering permissionless GPU access with blockchain-based settlement. These networks have demonstrated they can handle advanced derivatives by launching perpetual futures contracts on their native tokens. A decentralized autonomous organization could govern a QACU futures exchange using decentralized oracles for price feeds and stablecoin settlement. The DeFi path is fascinating because it bypasses the lengthy regulatory approvals of traditional finance while providing immediate global access to hedging and speculation. This could accelerate price discovery and market development in ways that traditional exchanges simply can't match.
Let's talk about what this all means for the future, because the implications go way beyond just creating another financial market. First, this enables much faster capital formation in AI infrastructure. When hyperscalers can use futures contracts to lock in guaranteed future capacity revenue, the risk associated with massive upfront GPU capital expenditure drops dramatically. This means faster deployment of AI infrastructure, which means faster AI progress, which means faster economic growth. We're talking about a financial innovation that could directly accelerate the pace of technological development. Second, it opens up entirely new categories of financial products. Once you have liquid QACU futures, you can build European options that allow buyers to hedge price volatility without locking into capacity commitments. You can create capacity swaps and swing options, similar to what we see in electricity markets. Large-scale AI developers could use these instruments to hedge their consumption patterns against both short-term price volatility and long-term technological improvement. But here's what I think is the most exciting part. This could democratize access to AI infrastructure investment. Right now, if you want exposure to the AI infrastructure boom, you basically have to buy shares in NVIDIA or a handful of hyperscalers. But imagine being able to directly invest in or hedge against the fundamental computational capacity that drives the entire AI economy. Pension funds, sovereign wealth funds, and institutional investors could get direct exposure to compute price movements. Hedge funds could develop sophisticated strategies around the unique characteristics of technological deflation and demand volatility. We could see the emergence of compute-focused ETFs, structured products, and alternative investment strategies.
There are also massive implications for how we think about economic measurement and policy. If compute truly is the new oil, then having proper price discovery and risk management tools becomes crucial for economic planning.
Central banks might start tracking compute price indices as key economic indicators. Trade policy might need to account for computational resources as strategic commodities. The risk management implications are profound, too. Right now, companies making multi-billion-dollar AI infrastructure investments are essentially flying blind. They have no way to hedge against technological obsolescence, demand volatility, or energy price fluctuations. QACU futures would provide the tools to manage these risks properly, which should lead to more efficient capital allocation and faster infrastructure development. I also think this could change how we think about international competition in AI. Countries that develop sophisticated compute derivatives markets might attract more AI infrastructure investment because companies can better manage their risks there. Financial centers like London, Singapore, or New York could compete to become the global hub for compute derivatives trading. As we wrap up, let me give you the key takeaways, because I think we're looking at one of the most significant financial innovations of our time. First, compute has genuinely become a critical economic input that deserves sophisticated financial markets. The combination of massive capital requirements, extreme price volatility, and technological obsolescence risk creates a perfect storm that existing financial tools simply can't handle. Second, the quality-adjusted compute unit represents a genuine solution to the fungibility problem. By creating a mathematically rigorous, quality-weighted index of computational utility, it becomes possible to standardize and trade what was previously a completely heterogeneous resource. Third, the financial modeling challenges are solvable, but they require adapting techniques from multiple domains. The Heath-Jarrow-Morton framework from electricity markets, combined with explicit technological deflation factors and two-factor stochastic models, can handle the unique properties of compute as a commodity. Fourth, multiple implementation paths are already developing simultaneously, whether through traditional exchanges, over-the-counter markets, or decentralized finance platforms. The infrastructure for compute derivatives is being built right now. And finally, the implications extend far beyond just financial markets. This could accelerate AI infrastructure development, democratize access to AI investment opportunities, and fundamentally change how we measure and manage economic risks in the digital economy. The researchers behind this QACU framework estimate that compute futures could become one of the largest derivative markets in the world within the next decade. When you consider that global AI infrastructure spending is projected to reach trillions of dollars annually, and that every dollar of that spending could potentially be hedged through derivative markets, we're talking about a market that could rival or exceed traditional commodity derivatives. This is happening right now, folks. The mathematical frameworks are being developed. The regulatory groundwork is being laid, and the market infrastructure is being built. Whether you're an investor, a technologist, or just someone trying to understand where our economy is heading, compute futures and the QACU framework represent a fundamental shift in how we think about value, risk, and investment in the digital age. Thanks for joining me on Mindcast today. This has been Will, and I hope this deep dive into the future of compute derivatives has got you thinking about the incredible financial innovations happening at the intersection of AI and finance. Until next time, keep your mind open to the possibilities.